A question that I often get asked by home buyers is what is the difference between a fixed rate mortgage and an adjustable rate mortgage, better known as an ARM? And I'm going to explain the differences to you. Now, with a fixed rate mortgage, that means that your interest rate will never change over the entire loan term. So if you have a 15-year or 30-year loan term, you can guarantee that your interest rate will stay the same. So your principal and interest will be stable, the same. The only thing that can change is your property taxes and your insurance. Now, this is the most common mortgage because of its stability. Everyone loves this because they know what the interest will always be. Next, you have the adjustable rate mortgage, or the ARM, and it's just as the name implies. After a certain number of years, your interest rate can adjust either up or down. So your payment can totally change and be significantly higher or less. And we all know that your interest rate will probably go up, because how often does it ever go down in your favor, right? Now, often you will see an adjustable rate mortgage listed in numbers. You'll see something like a 5/1, or you may see a 7/1, or a 10/1. That first number represents the number of years that your payment will stay fixed. The second number, 1, means that after that 5th year, for like in the 5/1, your payment will go up every year, up or down. This mortgage is a lot more riskier, and if you don't have a high risk tolerance, I would say to stay away from an adjustable rate mortgage and stick with the fixed rate mortgage. Now, you may be wondering, well, why on earth would anyone want an adjustable rate mortgage? One thing you need to know about the adjustable rate mortgage is that if you buy a home, you can get a lower interest rate than the fixed rate mortgage, and you can also get lower payments, and that's why it's so attractive. So you can start out initially with a lower payment, and then once you reach, after that 5th year and it starts to fluctuate, just be prepared that your payment can change. So this is great for someone who doesn't plan to live in their home very long. Let's say that you just want to live in your home for 3 years and then you plan to sell it. So then when it's time for it to adjust and change, it'll never affect you because you're just living there for 3 years instead of after the 5 years. And of course, it allows you to get into a home with a lower interest rate and a lower payment. Often you will hear lenders that will say, you know what, go ahead and get the adjustable rate mortgage to get the lower payment and interest rate. And then after a number of years, when the interest rates go down, you can refinance. And yeah, that could be the case, but sometimes it doesn't always work out that way because you really don't know what the interest rates will be when it's time to refinance. They could be way higher than what they are initially. What if something happens in your life where you don't still have that great job that you had when you first bought your home? Time to refinance, you don't